Good morning. It is exactly 5:33 on a very pivotal Thursday, August 20th, 2026. I'm your host, and, well, the futures are currently carving out a really tight range as we just kind of sit here and await that 8:30 labor data.
Yeah, the coffee is definitely strong this morning, and the tape might actually be stronger. We are seeing some really fascinating rotation out of the mega caps and into some of the laggards today.
Right.
So welcome to this deep dive on the bulls, bears, and the bell feed. We've got about 45 minutes until the pre-market volume really starts to cook, so, let's get you ready for the open.
Absolutely. So we're basically sitting on the tarmac, right? High alert, pre-flight energy. And the tape is just throwing off these incredibly mixed signals at us.
Oh, completely mixed.
Yeah, so S&P 500 futures, they're cautious but slightly optimistic, up about 14.25 points, sitting right at 5582.50. And Nasdaq futures are leading, up like 68.50. But to really understand this tension, we have to look at the overnight sessions. The divergence there was massive.
It was. I mean, the split between Tokyo and Hong Kong overnight, it just sets the entire tone for what we're going to see off the New York Open today. So the Nikkei dropped 0.85%, and that was driven directly by the Bank of Japan adopting a decidedly hawkish posture at their overnight meeting.
Wow, okay.
Yeah, the market is finally waking up to the reality of the BOJ's terminal rate trajectory.
And that BOJ pivot, I mean, that isn't just a localized headwind for Japanese exporters, right? Like the ones dealing with a stronger yen.
No, not at all.
When the BOJ signals tightening, they are actively pulling the rug on global liquidity. It triggers this massive unwind of the yen carry trade, which forces margin calls. And then you get aggressive de-risking across totally unrelated asset classes in Western markets. The cost of capital shifts globally before the U.S. even wakes up.
Right. It forces institutional desks to recalibrate their entirely leveraged portfolios. But then you look across the East China Sea at the Hang Seng.
Which jumped, what, 1.12%?
Yeah, 1.12% in the exact same overnight window. And that was driven entirely by the PBOC moving in the exact opposite direction. We're tracking fresh liquidity injections targeted specifically at the mainland property sector.
So you have one major Asian central bank aggressively draining the pool,
Yeah.
while the other is just frantically pumping liquidity back into their most fragile sector. It's wild weather out there.
It really is.
And meanwhile, Europe is mostly a non-factor in the macro narrative today, right?
Yeah.
The DAX in Germany is completely flat, down like a microscopic 0.04%.
Right.
And the FTSE 100 in the UK grabbed a mild 0.32% bump off some, resilient retail sales data.
Yeah, so all of this overnight cross-current just leaves U.S. equities in this massive holding pattern. I mean, institutional capital is basically just parked on the sidelines.
Just waiting.
Exactly. Waiting for the 8:30 a.m. Eastern labor data to dictate the next directional move. Today really has a singular, overarching narrative that will define the session.
And that's the labor market versus the consumer, right?
You nailed it. Those are the two macroeconomic tectonic plates grinding against each other right now. If the data aligns this morning, there is a very clear, unimpeded path for the S&P 500 to run up and test that 5,600 level by the closing bell.
Okay, let's break down the catalyst for that 5,600 test. So at 8:30 a.m., the Department of Labor drops the initial jobless claims. The street consensus is sitting at 224,000. But the real threshold we are watching is 235,000.
Right, that's the line in the sand.
Because we are deeply entrenched in this perverse bad news is good news cycle. The market is actively rooting for economic pain here.
Oh, 100%. A print above 235K pretty much guarantees the Fed's hand is forced for a September rate cut, which is exactly why the tech sector is salivating right now.
Right, because tech thrives on multiple expansion, and that requires cheaper capital.
Exactly.
But wait, let's unpack this for a second.
Yeah.
If we want a soft landing, why are we cheering for people losing jobs? I mean, aren't we playing with fire regarding the continuing claims? Because that estimate is sitting at 1.86 million.
We absolutely are playing with fire. The initial claims only tell half the story. That continuing claims number, the 1.86 million, that's the critical metric buried in the report.
Okay.
We are moving past the phase of companies simply, trimming the fat. If we see a sudden acceleration in the climb rate of continuing
The
claims,
climb rate, yeah.
it signals that structural labor hoarding is just over.
Right, because an elevated continuing claims number means the absorption rate of the labor market has just evaporated. People aren't just losing their jobs, they're stranded in the unemployment pool.
Exactly. They can't find new work.
So if that climb rate accelerates, we transition very quickly from celebrating a cooling labor market to pricing in a hard landing.
And the bond market is already front-running this exact scenario. I mean, the U.S. 10-year yield is pinned at 3.92% this morning, down 2 basis points.
Yeah.
Fixed income traders are currently pricing in an 82% probability of a 25 basis point cut in September. And we'll get further confirmation on that terminal rate trajectory when Richmond Fed President Tom Barkin takes the podium at 10 a.m.
So we have the macro labor data showing deep structural cracks, yet somehow the U.S. consumer is just completely ignoring the macro environment.
It's wild.
It really is. Let's look at Target's earnings print from this morning. Ticker TGT is up 4.1% in the pre-market because they just absolutely crushed expectations.
They really did.
They posted $2.02 on the bottom line against a $2.18 estimate.
The margin expansion there is notable, especially considering the elevated logistics costs we've seen this quarter.
Right.
But the most revealing metric is their comp growth coming in at 2.1%.
Oh, wow.
Yeah, foot traffic and average ticket sizes are actually accelerating. Consumers are still actively transacting at a volume that, well, it directly contradicts all the labor anxiety we just talked about.
But if you look at the broader macroeconomic data, that 2.1% comp growth is happening against a backdrop of incredibly high, like maxed out consumer credit card balances and rising delinquency rates.
Yeah.
It really raises the question of whether this is actual middle class strength or simply a trade down effect, like higher income cohorts abandoning specialty retail and just consolidating their spend at discount big box stores.
Oh, it's definitely masking some underlying stress. The consumer composition inside that comp growth is shifting.
Yeah.
But tactically speaking, the immediate reality for traders is that Target has established a very clean gap and goes set up on the daily chart.
Okay, so what's the level?
With the pre-market volume we're seeing, the critical level to watch off the open is $158.50.
Got it. So if institutional buyers defend that 158.50 level and they consolidate the gap up through the first 30 minutes of the regular session, the VWAP dynamics should heavily favor the bulls, right?
Oh, absolutely.
Because the options chain suggests there is very little overhead supply until the 165 resistance zone?
Exactly. The lack of selling pressure above 158.50 forces the momentum algorithms to just chase the tape. But this micro consumer strength from Target, it's heavily contradicted by the massive institutional footprints we are tracking in the dark pools today.
Oh, this is the good stuff.
Yeah, the pension funds and mega-cap asset managers are playing an entirely different game beneath the surface of the index.
Right, because we caught a massive print late yesterday afternoon in the dark pools. A $1.8 billion block buy on the SPY ETF, right at the $552.50 level. And when you combine that block with the current options positioning, we have a classic bumper bowling scenario playing out on the S&P 500.
I love that analogy. Bumper bowling.
Yeah, right.
Yeah.
That $1.8 billion dark pool print acts as the left bumper. It establishes a concrete floor at 552.50.
And the right bumper is the massive gamma flip level sitting exactly at 55.40.
Okay.
The structural mechanics here are just dictating the price action.
Right.
Because dealers are deeply long gamma above that 55.40 trigger, their risk models mathematically force them to buy futures when the index dips.
And sell when the index rallies.
Exactly.
It creates this artificial shock absorber on the tape. As long as the SPY holds inside that channel, the options market makers are effectively suppressing volatility, which is exactly why we see the VIX completely pinned this morning, near 14.50.
Yep, it's totally boxed in.
The index is just mathematically drifting toward that 5,600 target.
But underneath that suppressed volatility, the sector rotation data is flashing massive warning signs.
Tell me about it.
The institutional flow is aggressively rotating out of the XLE.
The energy sector.
Yeah, and they're piling into the XLV, the healthcare sector.
Oh, wow. That is a glaringly defensive posture.
Incredibly defensive.
Because energy relies entirely on a reaccelerating PMI and a booming cyclical economy, right?
Right.
So rotating out of cyclical energy into high-yield defensive healthcare indicates that the largest pools of capital are hedging their bets against a recessionary labor print. They're just completely ignoring the surface-level optimism in the S&P 500.
They are locking in duration and hiding in sectors that have inelastic demand characteristics. I mean, it's a late-cycle playbook being executed in real time.
Yeah.
This defensive positioning in the broader market makes the price action in the high-beta tech names incredibly volatile off the open.
Which brings us perfectly to the specific tickers that are dominating the tape this morning. Let's look at Tesla. Ticker TSLA is up 1.8% in the pre-market. And that's being driven by the structural noise coming out of Europe regarding an imminent licensing deal for their full self-driving software with a major European OEM.
Yeah, and a finalized OEM licensing deal, I mean, that fundamentally alters Tesla's valuation multiple.
For sure.
It accelerates their transition from a capital-intensive auto manufacturer to a high-margin software business. The market has been waiting for validation of the FSD licensing model, and the technical setup on the chart really reflects that anticipation.
Because Tesla is rapidly approaching the $225 psychological resistance level. And if you look at the short interest, that 225 level isn't just a line on a chart. It is a massive graveyard of short seller stop losses.
A total graveyard, yeah.
If the stock crosses that threshold with volume, dealer delta hedging is going to force massive algorithmic covering.
And the feedback loop there becomes explosive. As the stop-loss market buys trigger, dealers who sold calls have to buy the underlying stock to remain delta neutral.
Which just pours gasoline on the short squeeze.
Exactly. If 225 breaks, the volume profile suggests a violent, low-friction move straight up to the 238 zone before any real supply hits the market. It could be wild.
Okay, so from the explosive upside in Tesla, we have to look at the anchor dragging down the semiconductor space this morning, NVIDIA. Ticker NVDA is down 1.2% in the pre-market, and the tape is entirely devoid of fresh, fundamental news.
Nothing. It's pure institutional de-risking ahead of their quarterly earnings report next week.
Right.
Given NVIDIA's immense weighting in the index and its, frankly, astronomical valuation multiple, the entire market's momentum is tethered to their forward guidance. Portfolio managers just cannot afford to carry unhedged exposure into an event that binary.
And we're seeing the exact footprint of that fear in the options flow, aren't we?
Oh, absolutely.
There is massive institutional hedging, heavily concentrated at the $120 put strike. They are actively paying up for implied volatility to protect their underlying long books in the event of a guidance miss and a gap down.
Yeah, the premium they are willing to pay at that 120 strike tells you everything you need to know about the perceived tail risk. But, while NVIDIA is just experiencing pre-earnings multiple compression, Snowflake is suffering an outright structural repricing today.
Oh, man. Snowflake.
Ticker SNOWW is down 8.5% in the pre-market after clipping their full-year product revenue guidance.
Snowflake is the ultimate casualty of multiple compression in the SaaS space right now. I mean, when a cloud consumption model with a premium valuation lowers forward guidance by even a fraction of a percent in a high-rate environment, institutional desks just ruthlessly liquidate.
They do not care.
The market simply will not tolerate duration risk on slowing revenue.
The repricing is brutal, and it's algorithmic.
Right.
But for the tactical trader, the severity of the liquidation creates a very specific mean reversion setup.
Okay, what are you seeing there?
So Snowflake's 4-hour RSI is currently flashing a deeply oversold signal. This indicates that the selling velocity has completely outpaced the structural shift in their fundamentals.
So the rubber band is stretched to its absolute algorithmic limit.
Exactly.
Snowflake is approaching its historical support floor at the $122 level. So if the indiscriminate selling exhausts itself at 122, it sets up a high-risk, high-reward long entry for a mechanical bounce back toward 130, right?
Right.
Driven purely by short sellers locking in their overnight profits.
It requires incredibly tight risk management, though, because catching falling knives in the SaaS sector is notoriously dangerous.
Oh, yeah. Don't try to catch a falling knife.
Right, but the volume shelf at 122 provides a highly definable invalidation level for the trade. If it breaks 122, you just get out.
Simple as that. Okay, we are just minutes away from that 8:30 a.m. data drop, so let's lock in the tactical summary for the session. The entire morning hinges on the initial jobless claims. We're tracking that 224,000 consensus against the 235,000 threshold. If the labor data forces the Fed's hand and targets consumer resilience holds up under regular trading volume, The broader market has a very clear fundamental runway.
Definitely.
As long as those dark pool bumpers hold the SPY above 5540, the mathematical target for the S&P 500 today is 5600.
And as the volume accelerates off the open, I want our listeners to filter the price action through one final macro puzzle.
Big roll laid on us.
We've laid out the deep structural contradiction on the tape today, right?
All right.
Target is printing massive comp growth because consumers are still actively pulling forward demand.
Yeah.
Yet simultaneously, the most sophisticated pension funds on Wall Street are abandoning cyclical energy to hide in defensive healthcare.
A huge divergence.
It is. This raises the ultimate question for the back half of 2026. Are U.S. consumers actually spending from a position of sustainable economic strength? Or are we simply witnessing the exhaustion spending phase, fueled entirely by maxed out credit, right before the structural cracks in the labor market finally give way?
Wow. That is the defining tension of this entire cycle. I mean, are the macro instruments lying to us while the storm gathers, or are we truly clearing the turbulence?
Exactly.
Watch the tape today, folks, because the capital flow is about to tell us which narrative is real. Good luck out there as we head into the heat of the opening bell.
And remember, the trend is your friend until the bend at the end. Don't fight the tape today. Thanks for starting your morning with us.
Yeah, and before you get completely consumed by the price action, do us a favor, hit that follow button and subscribe to us on your favorite platform so you never miss a deep dive. It helps us keep the light